Welcome to this Colorado Bar Association continuing legal education program.
I'm Nate Trelease. I'm here with Hendrik Jordaan of Morrison and Foerster here in Denver, Colorado. Hendrik is moderating one of the 4 panels at the Private Equity Conference of the Colorado Bar Association on January 21. Hendrik's panel is particularly focusing on how to make the deal work in a challenging economy, in a transitional economy, and in a growing economy. Hendrik is one of the leaders of the community here, and we're very happy to have him join us for the conference.
Thank you.
Hendrik, can you tell us a little bit about what you see as the major stumbling blocks, as I mentioned, between a free-fall economy slowly transitioning into stability and growth?
Right. Well, I think we're at a really interesting point. On the one hand, you have some industry verticals and some funds that are getting a lot of deals done, that are getting deals done on terms and conditions really akin to what we saw in 2007. On the other hand, you're seeing a lot of deals struggling. You're seeing a lot of companies and private equity funds struggling to get capital out, trying to raise the requisite leverage to consummate their transactions. And so it's really a tale of two cities in many respects. On the one hand, deals are getting done, exits are being achieved, some real positive signs. In other areas, it's very much a struggle.
Okay. So it's sort of Dickensian. In the verticals that are struggling, what are we negotiating over price? Are we negotiating over substantive terms? What are we negotiating on?
Yeah, I think one of the main struggles that a lot of sellers of companies, whether it's private companies, boards of directors of public companies are going through is coming to terms with how long the sluggish economy we're in, and in some cases, depressed multiples are going to hang around. On the one hand, you have a mindset that says, look, let's hang on, let's firm up the balance sheet, let's continue to grow our businesses, and if and when the time comes, and at some point it will, we'll be in a healthy position to go to market. On the flip side of it, you've got companies saying, well, you know, or sellers, for example, in the private company context saying, it doesn't make sense for me to take some money off the table today, even if it's less than what I would like. Diversify my financial holdings so that it's not concentrated only in my private company that may represent currently the bulk of my wealth. Does it make sense for me to take some really exciting risks in areas such as real estate, where you've got some incredibly depressed prices, or in various other investment verticals that are out there? And so you're seeing a lot of sellers, boards, individuals, families struggling with coming to terms with those opportunities. And likewise on the buy side, you're seeing some funds being more aggressive, putting capital to work. We've seen a fairly robust, and it's shaping up to be a fairly robust second half of 2010. It looks like it's going to be more robust than the first half, certainly an uptick over 2009. But again, fairly tumultuous in many areas.
Well, you have a substantial technology practice here at Morrison and Foerster. A growth area, not a growth area? What are some of the deal trends that you see there?
Yeah, absolutely. It's really interesting. We've been at MoFo have seen just a real significant uptick on the technology side, both domestically and internationally. We do a lot of work in Asia in particular, and we've seen a real robust M&A environment in Asia. Locally, with technology changing very quickly, companies establishing beachholds in various technologies, using all that cash that they've been hoarding on their balance sheets to aggressively go after targets that otherwise may not have been as vulnerable in healthier times. You know, by way of example, we closed the $7.7 billion Intel McAfee deal, the Intel Infineon deal, which is $1.7 billion. Both of those deals are examples of Intel in a large strategic public company, again, being in a strong position and acting in an environment when some of its competitors may not be as aggressive.
Talk to us about some of the creative solutions that you've come up with to help buyer and seller bridge the gap.
Sure. No, it's always one of those that is not always as easily done as it may appear. But the obvious solution that is thrown out there are earnouts. There's multiple structural solutions you could use, from continued value rights in a public company deal. Most likely what we see a lot of are earnouts in the private company environment. It's a tool that's used. It's, I think, you know, many comments about earnouts. You know, often earned, seldom paid, seldom earned, often paid, depending on where you sit. But suffice it to say, earnouts are heavily disputed portions of M&A deals, really critical for practitioners early on in the process to understand the traps that really surround earnout drafting, and also not just drafting the deal and negotiating it, also living with the earnout. after the deal is consummated, understanding and tracking, if you would, the covenants that may be relevant and how the earn-out will actually be enforced.
Hendrik, you're the chair, one of the leaders of the American Bar Association task force on using case studies to help bridge the gap. Can you talk to us a little bit about that project, where it is and how it's helping you as a practical matter?
Yeah, it's really interesting. The ABA, really through the Negotiated Acquisitions Committee, what's now the M&A Committee in the Business Law section, has established what I consider to be the platinum standard in terms of deal point studies. There are many deal point studies out there, some prepared by law firms, some by investment banks. Suffice it to say, the private target study that is most frequently cited, I think, in the private equity or private company M&A context really reflects the thinking and the quality control of a very large number of practitioners on both coasts, really internationally. High degree of quality control. The study itself is really not intended as a blueprint in terms of getting a deal done. It's intended more as a tool, simply a tool that could be used in sketching, if you would, the broad parameters of the fairway. To mix my metaphors, have to throw in a golf metaphor somewhere. In any event, the study itself is very helpful in that regard. I have found to sketch, broadly speaking, what the fairway looks like, recognizing that every deal is unique. And to share a quick anecdote, we worked on a deal recently that the opposing counsel kind of threw the study down, cited it with significant passion, and said, look, clearly this is the way deals get done. I mean, look at this. This is evidence of what's market. And the problem was he was citing an incorrect study, which didn't really help his position. So the point is, use the study carefully, use it sparingly, use it in the right situation, and don't blindly rely on it, because that can come back and bite you.
Very good. Fairway, full of sand traps, or after years of talking optimistically after the free fall about things growing, is activity in this industry growing?
I think there's some really, we're shaping up to have a very, very busy fourth quarter. A lot of deals are going to get done in the fourth quarter, as notwithstanding the somewhat positive news, I guess, depending where you sit in terms of tax changes that may be extended, capital gains not increasing potentially. Still a lot of sellers trying to get deals done by year end. Investment bankers trying to get deals closed by year end for financial and other reasons. So it's shaping up to be a very, very busy fourth quarter. As I look into the pipeline for Q1, I think it's very similarly, it's going to be a very robust first quarter that we're seeing. But I think it's not every single fund, it's not every single firm, it's not every single group. It's if you're in the right vertical, working with the right clients, you can be incredibly busy. If you're outside, if you're with the swim lane of a lot of activity, it can be really slow. So I think you're seeing a real bifurcation in terms of activity. I think some of the industries will continue to be hot. I think technology is going to continue to remain very hot. I think healthcare, we're certainly seeing a lot of activity in. Aerospace is another one. Ancillary clean tech industries, we're noticing a lot of activity in. Certain kind of niche manufacturing plays, very, very interesting and commanding some nice multiples. So I think it's going to be an exciting time ahead.
Well, Hendrik, you have a national and international practice, but here we stand looking at a beautiful Denver, Colorado.
Right.
Talk to us a little bit about two important industries here, clean tech and maybe also real estate.
Yeah, so good question. Clean tech is, certainly in MoFo's, we're really started primarily out of our San Francisco office. Noticing a lot of activity, a lot of capital chasing clean tech opportunities. There's still a lot of technology risk around clean tech. Whether you're in the wind, solar, pick your vertical within clean tech, certainly still some technology risk. And what we're seeing a lot of private equity funds reluctant to move too aggressively into clean tech projects, A, because of the technology risk, and B, because of the lack of stable cash flows and sometimes very significant CapEx that needs to be invested in order to recognize the returns. More of a venture capital model around a lot of the clean tech areas. The ancillary services where companies are cash flowing nicely, you've got $5 million up in EBITDA, all of a sudden it becomes a very attractive or more attractive play for a lot of private equity funds. Real estate, again, it's you look at a lot of pain. You talk to a lot of real estate executives, and they will say to you that there's still a lot of inventory that needs to move through the system, a lot of pain that needs to move through the system. Conversely, you look at some really exciting stories. You look at a company like KSL Capital, it's a Denver-based private equity fund, and recently closed several deals. I believe Squaw Valley, I believe they own the Del Coronado, La Costa. Have been very aggressive and very successful in pursuing a real estate-based, in part, strategy around that vertical that's otherwise seen a lot of pain. A related area that continues to be interesting is data centers. You look at CoreSite, which is the local company, data center publicly traded REIT in Colorado, that is an example of a real estate related play. Again, not just a pure development play, but an interesting real estate related play that seems to be getting some good traction.
One last question. You talked about the technology risk of clean tech. How about the regulatory risk?
Well, I tell you what, regulatory risk to me is a concern that is rippling through all elements and aspects of M&A at so many levels. Whether it's on clean tech, I would submit to you, private equity broadly defined. You look at the challenges facing the private equity industry, and I would say to you, perhaps even more profound than liquidity, perhaps more profound than leverage, although we are seeing leverage tick up in multiple deals, is regulatory risk. Where is it going to sit? The amount of regulation that many funds are facing, and what the future holds for the industry and for the asset class. I think it's a fascinating question. In terms of pricing regulatory risk into deals, I know that's an issue that whether it's on clean tech, whether it's on healthcare, whether it's in aerospace, whether it's on cross-border deals, regulatory risk certainly permeates the investment theses that many private equity funds are espousing, and quantifying that is a very, very difficult task. Again, above and beyond the deals themselves, how the funds are going to operate and how they're going to be regulated is a challenge that everybody faces. And I think it's going to be a drag on the industry for a period of time.
Very good. Hendrik Jordaan, Global Co-Chair of the Private Equity Practices of Morrison and Foerster. Thank you for joining us.
Okay, terrific. Thank you.